Hello everyone, my name is Craig Adler. I'm a retired certified financial planner. I'm also sometimes known as the Angry Financial Planner. During my career, one of the most frequently asked questions was, what should I do with my old employer-sponsored 401k or retirement account? In today's video, I'm going to be answering that very question. If you have an old 401k or employer-sponsored retirement account, you have three different options on what you can do with that plan. Option number one, you can leave that money in the old current plan. Option number two, if you have not retired and you have gone to a new employer, in most situations, you will be able to transfer that money into the new employer's plan. And option number three is you can go down to any financial service firm you are comfortable with, open up what's called an IRA rollover account, and transfer that money into the new IRA rollover account that you either have had in the past or that you have opened up for this very purpose. Now what we have to do is try to decide which of those three options is best. The good news is this: one option is not going to be any better than the other. This really comes down to personal choice. From a performance perspective or the overall financial result, the decision that you make for the most part is going to be irrelevant. This really comes down to personal choice and what decision is best for you. With that being said, I do have a priority, and I'm going to share that with you in just a few minutes. But first, I need you to know there are two special situations that do change the answer to the question. Special situation number one is this: if you plan on retiring between age 55 and age 59 and a half, and you plan on using that retirement money to live on, you are going to want to leave that money in that last employer's retirement plan. The reason why is this: if you take money out of an employer-sponsored retirement account before age 59 and a half, in addition to that income being taxed as ordinary income, there is going to be a 10% penalty. One way we can avoid that penalty is through something called the Rule of 55. What that will allow me to do is once I turn age 55 and I retire, I can now take that money out and avoid the 10% penalty. I can only do that though with my final employer's 401k account. For that reason, if I plan on retiring before age 59 and a half, and I need that money to live on, but I am at least age 55, I can avoid that penalty, but it will only work if I leave the money in that last employer's retirement account. The second exception is what's called net unrealized appreciation, or sometimes NUA for short. Net unrealized appreciation will allow us to take highly appreciated company stock out of that employer's retirement plan far more tax efficiently than we could otherwise. This is really easiest understood with an example. So in this example, I work for Google and I have $100,000 of Google stock in my employer-sponsored retirement plan. With a normal distribution, I would sell that stock, and when I remove that $100,000 to live on, that $100,000 is going to be taxed as ordinary income. Through this concept of net unrealized appreciation, I can get that $100,000 out of the account far more tax efficiently, and this is the way that process works. That $100,000 of Google stock, let's just assume that my cost base was $10,000. So I paid $10,000 for that investment, but it grew to $100,000 through appreciation. What I can do is I can move that entire $100,000 Google stock position into a taxable account. When I do that, I'm going to pay tax on $10,000, the cost basis, and that tax will be at ordinary income tax rates. However, that $90,000 of capital gain, it will not be taxed until I sell that individual position of Google stock. What I've essentially done is I have converted $100,000 of ordinary income into $10,000 of ordinary income and $90,000 of a deferred long-term capital gain. Since long-term capital gain rates are much lower than ordinary income rates, this will almost always be tremendously beneficial to my overall tax situation. Not only that, by getting that $100,000 out of retirement account, it is going to reduce my required minimum distributions for the rest of my life. This critical point is almost always missed. So earlier I said that the three options with your retirement plan from an employer are to leave it in the old plan, move it to a new employer's plan, or to transfer it to an IRA rollover account. I also said to you, the decision that you make is not going to change the financial result. It really comes down to personal choice and which option is best for you. So assuming one of those two exceptions, the rule of 55 or net unrealized appreciation, does not apply to your situation, I still have a preference. My preference is I want my personal finances to be as simple as possible. I achieve simplicity by keeping the number of accounts I have to a minimum. For that reason, I have opened up an IRA rollover account, and every time I change employers, I essentially transfer that retirement plan to the new IRA rollover account. So I will essentially end up with one retirement account. This is not only easier for me, but it is going to be tremendously easier for my heirs and beneficiaries. As an example, if you have 4 retirement accounts and each account has your spouse, a son, and a daughter as the beneficiary, the day that you pass away, those 3 beneficiaries are now going to have to work with 4 different financial institutions. They are going to end up with 12 accounts. 4 different financial institutions will now have an account for your spouse, your son, and your daughter. It just becomes an administrative nightmare. And this is another reason I believe you want to keep your account total to the lowest number possible. So summarizing, what you do with an old 401k account comes down to personal choice. You can leave it in the old plan, you can transfer it to a new employer's plan, or you can open up an IRA rollover account. Even though the financial result shouldn't be any different, for me, I prefer the IRA rollover account because it's simply easier for me to manage, and it's going to be much easier for my heirs and beneficiaries. However, if you do have a situation where you have appreciated company stock in that plan, or you need that money before age 59 and a half, but after age 55, those would be reasons to leave the money in the existing plan and not touch the money until you implement one of those other 2 strategies. I hope you found this video beneficial and helpful. As always, new subscribers are a wonderful treat, but I have created this channel with a primary goal of improving your financial literacy. I hope we are achieving that objective. And remember, when it comes to your money, it is always better to be educated than angry.